what I do with income investing is try to find investments, and there are plenty of them, that they're more likely to be high dividend stocks like utilities and master limited partnerships, and you know, things that are more income focused and not growth focused. And then I also use a lot of high yield bonds and senior loans, and I combine it with investing through closed end funds where you can typically buy at discounts. So you can get 9, 10%, 8, 9, 10%. Covered call funds or another one, you can get 8, 9, 10% consistently year after year in return, in real cash returns that you can reinvest and create your own growth.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Now, okay, folks, in today's video, we're delivering on one of the most popular requests you've been asking of me, to produce a video on how to invest for income. We're joined today by Stephen Bavaria, author of the book, The Income Factory, an investor's guide to consistent lifetime returns. Stephen, thanks so much for joining us today.
It's a pleasure, Adam. Thank you.
Well, I really appreciate you jumping on relatively short notice. As I said, this is a very high interest topic amongst this audience. I appreciate you helping demystify the world of income investing here for folks. So as we jump off of that and then get into your framework, you've got a very specific framework you call the Income Factory. But before we get to that, though, we could just start at a very high level, which is why invest for income? You know, a lot of people are buying a stock or a security because they hope it's going to go up tomorrow. Investing is a bit of a different strategy. Why invest in it?
Well, actually, the two tie together very well, growth and income. If you go back to basic economics, and there was a guy named John Burr Williams, an economist in the 30s, who wrote the book that is still the basis for investment theory, you know, around the world. The value of any investment, of any asset really, when you come right down to it, is the discounted present value of all the cash flow, all the income that asset is going to generate over the course of its life, or the investor's life, certainly. And we don't always realize that market values go up and down for all kinds of reasons, but the ultimate reason most of us are investing is because we're looking to the assets to ultimately generate an income for us. And if we invest in a way that grows we can use cash flow from the investments, reinvest it, and actually create our own growth. In fact, this is the basis for my own philosophy that I call the Income Factory, but I came to it through my own investing and realized that over time, you actually can grow your wealth faster and more consistently by concentrating on income than you typically can for most investors by looking at growth and focusing on market value. And the reason for this is that they know for the last 100 years or so, equity on average has provided a return of 9 or 10%. If you can achieve a 9 or 10% growth on your investments over the course of your life, you're going to double and then redouble and redouble again the income or the value of it about every 8 years at a 9% rate. It's the rule of 72. You divide the yield into 72 and it tells you how often it'll double and redouble itself. But most people do not achieve this kind of a return because they focus on market price. And of course, the media focuses on market price. So we're kind of brainwashed to think about market prices that go up and down. Whereas typically 10 years later, 20 years later, people don't even remember the price at which they first bought a particular stock, if they're still holding it, or bond or whatever. But the income growth, compounds and continues. So for the typical person who invests in stocks, they watch it go up and down, because unlike bonds and other fixed income, you don't have steady growth due to dividend compounding or income compounding. You have the ups and downs and the volatility. And if you're smart, if we're all as wise as possible, we would just invest in index funds and forget about it for year after year after year, and we would do fine. And Nobel Prizes have been won telling people this. But most of us, myself included, don't have the iron will required to sort of sit through volatility of all sorts. And with a typical stock portfolio, you make, if it's an S&P 500, for example, you'd make 1.5% in dividends, and the rest of your 9 or 10% equity growth is dependent on growth year after year. And you're not going to get it every year. So the years when you're getting minus 10%, hopefully to be made up by other years where you get plus 20%, let's say. It's not exactly that. Mathematicians will be calling and complaining, but you know what I mean. It's hard to just sit and wait and watch. So most people then try to hedge the volatility by buying things like long-term bonds and other fixed rate stuff where you get stability. But yes, stability, but over the long term at a return of 3 or 4%. If it's a typical investment grade or government bond, over the last 10 years, it's up to 4 or so now for a while. So you put it all together, and you're lucky if you blend the portfolio with these so-called stable assets that are like a rock pulling, on a boat. They gives it stability, but it slows it down. And then your other equity portfolio that maybe will grow at 10%, but you combine the two, and maybe you've got 6, 7%. And then people try to time the market, and that usually costs them money because they're sitting on the sidelines when the train starts to pull out of the station again, and stocks take off. So it's very, very hard for a typical investor to just invest in equities and sit and watch it and let it grow over the long term, which is what they would need to do. So what I do with income investing is try to find investments, and there are plenty of them, that they're more likely to be high dividend stocks like utilities and master limited partnerships, and things that are more income focused and not growth focused. And then I also use a lot of high yield bonds and senior loans, and I combine it with investing through closed end funds where you can typically buy at discounts. So you can get 9, 10%, 8, 9, 10%. Covered call funds or another one, you can get 8, 9, 10% consistently year after year in real cash returns that you can reinvest and create your own growth. And you're not necessarily growing the market value, which may move all over the place, but you're not paying attention to it. You're looking at your income, your cash income, which is growing and compounding if you're in a growth mode. Now, if you're a retiree, you may be taking some of this out and living on it and just reinvesting parts of it. And we'll talk about that later. But you can therefore create your own growth, reinvest. And when markets are down, this is a psychological thing as well as a financial thing. It's easier to sleep at night if you know your income is growing steadily regardless of what the market prices are doing. And when market prices are down, you're reinvesting at even lower prices and higher yields. So you're growing your income faster, even during periods when the market prices are down. Like in 2022, I grew my income at about 11%. My portfolio I invest in funds, primarily closed-end funds and ETFs mostly, because I like the diversification. I want professionals managing my money and not picking. I would never want to try to pick individual bonds or loans myself, but I let professionals do it. And so I've got a portfolio of funds invested in all this, and some of those funds were down in paper value in 2022, for example, but they were cranking out their income at a faster rate than ever, at a higher yield than ever, and I was reinvesting. So I've been consistently growing my income at a 9, 10, 11% rate for as long as I've been doing this, even though the value of it in terms of market value, it, bounces around, but I don't pay much attention. And when I started writing about this, taking this approach on Seeking Alpha primarily, I was called a heretic. I had people saying, you can't do that. You've got to have growth. And I said, no, math is math. If you make 10% yields and 0% growth and 0% yields and 10% growth, and you compound it, you're going to end up at exactly the same place. And I had to prove that on Excel spreadsheets and stick them in my book and on articles. And finally, now I've got thousands of followers who tell me, gee, I'm sleeping better at night. You've changed my life. I've never thought of income investing as, it may not be sexy, but it sure works. That's a long-winded answer, but there you go.
No, it's a great answer. And look, I think there's a lot of people watching who you probably just got their attention first off with just the 9 to 10% annual average returns, but also the fact that income generating assets tend to have substantially lower risk than a lot of growth assets. And so to be able to earn that attractive a rate, with the relative safety of fixed income, I'm sure folks are watching pretty intently right now. So I'm really looking forward to getting into this discussion. You mentioned a couple of asset classes there that folks might not be super familiar with. So hopefully at some point we can just talk briefly about what they are, so they know how to go learn more about them after this video. Let me ask you this first. So you said a lot of people, which is very true. I would say the average retail investor tends to invest more in stocks than in fixed income. Fixed income instruments are a little mathy. That scares people. Also, what you sort of tend to hear on the regular financial media, you tend to hear much more about the equity side of things. And I think that's just because it's more interesting. It's, to use your term, it's a little more sexy. Everybody loves a story like in NVIDIA or like the meme stocks when they were running about how riches can be made overnight. But a lot of that is it's riskier, but there's a line I think that's been really blurred over the past decade or more between investing and speculating. We have, especially post the 2008 global financial crisis, we enter this era where financial markets, but particularly the equity side, was supported and juiced by a lot of central planner stimulus. And you had a lot of years where the market just had gain after gain after gain after gain. And the mantra was buy the dips. You've got the Fed put, the Fed's got your back here. And as part of that program, it drove interest rates down to zero practically. And that made it really hard on the fixed income side to generate an attractive return, at least from a lot of people's perspectives. Now, what's different about the era we're in now is you actually have yields up at a place where they're somewhat meaningful again. In fact, I think treasuries are now delivering a real return, which hasn't happened in a long time. So is this now an even better environment for those that want to build an income factory?
I'd say probably yes, although it's always been perhaps a better environment than people would have thought if they were just looking at fixed income the way the media and others describe it. It's very important to understand that not all fixed income is the same. And the bets we're taking, if you will, when we invest in different parts of the fixed income market, we're taking very different bets. We're investing in a different set of possibilities and probabilities and expectations. The typical fixed income commentary, say on CNBC, doesn't even talk about the kind of fixed income I would invest in. They're talking about the treasury market, the long-term bond, investment grade bond market. These are markets where you've got fixed rates. You're going out 10, 20, even 30 years on treasuries. You're basically betting on interest rate movements, and you're not being paid very much to take those bets because you have virtually from a statistical point of view, you have hardly any defaults in the investment grade sector, especially the higher end of it. And of course, in the Treasury, we don't know what's going to happen to our government bonds, our debt, years from now. But as long as it's denominated in US dollars that they can create more of, you're not going to have defaults by the US government in any foreseeable future. So you're really betting on interest rates. I'm talking about investing in credit. Now, when you're investing in credit, you're being paid real returns. You're getting much higher yields because you're taking real risk. And high yield bonds and senior loans, which are asset classes that are totally available to retail investors through the closed-end fund market, especially, you can get currently 9, 10, 11% returns, yields, I should say, yields on these asset classes, because you are taking real credit risk, but you're being well paid for it. And credit risk, here's something most people don't understand. High yield bonds, which basically started with Michael Milken and way back in the 80s, and they got called junk. They're called junk bonds because they're from non-investment grade companies. There's so many people say, oh, I would never touch a junk bond, it's so scary and risky. Many of those people, in fact, most of them, probably already hold stock in mid-cap funds and small cap funds that's issued by these same companies who issue high yield bonds. Now, the non-investment grade companies, most companies that we've ever seen are non-investment grade. And the stock issued by these companies that is bought universally by investors who have highly diversified stock portfolios, small caps, mid caps, is all below on the balance sheet the debt that these investors say, oh, I'd never buy that. That's high yield bond. Well, unless those high yield bonds are paid off, the stock that many of those investors already own is worthless, because it's, if the company goes bust, you're not going to get anything back as a stockholder. But if you're a bondholder, or especially a secured senior loan holder, and senior loans are a big investment, a big asset class I like, you're going to probably lose on a high yield bond. You'll have a recovery of maybe 40%. So you'll lose 60%. On a senior loan, you'll have a recovery of 60 or 70%. So you lose 30%. So even in a normal year when defaults are, say, 2%, if they're that high on non-investment grade companies, you might lose half of that. You might lose 1%. If you lose 50% and you've had defaults on 2% of your portfolio, then your loss will be half of that, 1%, 50% times 2%. So, and then even in a recession, you might have 5% defaults. So you lose half of that, that's 2.5%, which you're earning 10%. So 2.5% might reduce your earnings that year to 7%, but it won't even touch your principal. So there's a lot more security and predictability in the credit markets, the real credit markets, where you get paid for taking credit risk, than there is in any equity market. And this is why I find once I start explaining to people what you're really betting on and what the risks are, it makes a lot more sense to them, and they say, wow, I never knew that. And then I have a lot of readers and members of my group that they tell me a couple of years later, wow, this is great. I never knew you could invest like this and get, these kinds of returns and sleep at night.
Okay, great. You fast forwarded to a question I was going to ask around some of the debt instruments that are lower on the seniority ladder. You just answered that question, which is great. And I think that is a great reframing in people's mind is, hey, if you're owning a stock, and in most companies, like you said, unless it's a real big blue chip company, it's probably not an investment grade company. And if that company gets into trouble, your stock's going to take a much bigger loss than whatever variety of debt you have, because the debt is higher on the seniority list than the equity.
May I make one little point too? That
Absolutely.
one way I like to think about this is when you get into credit investing, and a good 50% or more of my portfolio and my models is in credit investing, and part of the equity that we invest in is the equity of business development corporations, which in fact all they do is make credit. So even I consider that part of credit as well. But I think of it as if you went to a horse race, you went to a racetrack, if you could bet on the whole field of horses to just make it around the track and finish the race, that's what credit investing is. You're just betting on companies to not go bust, to stay alive. And, even if they don't do well, even if their stock tanks, as long as the management keeps the company alive and, the horse makes it around the track, you're going to do fine. You're going to get paid. When you bet on stocks, it's like betting on, a horse to win, place, or show. It's got to do well. It's got to not only survive and finish the race, it's got to increase its earnings and its stock price. So it's a very different bet. So unless you're getting paid a lot more to buy the equity, you're better off just taking the credit bet.
That is a great analogy. So, a bond, a credit instrument, it's a contract, right? It basically says, hey, if I'm still around by time X, I will have paid you this along the way, and then I'm going to give you your principal back, right? So to your point, that horse just needs to finish the race.
Even if the company's really run into problems, laid off half its people, I've worked for companies that have had to do that, but they have to meet their contracts and pay their debts or they're gone. And let's be honest, the CEOs of companies and other people, I wrote a book called Too Greedy for Adam Smith about CEO pay and how it's out of control. But CEOs and the other management of these companies have enormous skin in the game to do whatever they have to muddle through and keep their companies alive. And that's real. When you think of corporate America that way, even in the worst recessions, you've got most managements have just got enormous skin in the game to kind of get their debt holders paid, no matter what happens to their stockholders. And that's what I'm betting.
So here you're basically saying, look, investing in this type of world, you've got the system pulling for you. The system's own self-interest is trying to help you out here. All right. Well, look, I think we've laid a lot of good groundwork here. Let's perhaps transition to in just a second, because I got one more question I want to shoehorn in first. But let's transition to your framework here of the income factory. What exactly is it? How does one build it? And then maybe what are some of the elements that people could put together to create their own income factory? Very quickly, I should have asked this earlier, but how should an income strategy, the need to basically who should be investing for income? Is it just as relevant for a 23-year-old as it is for a 67-year-old, or obviously does age and personal situation come into play here?
Well, here again, it has to do with psychology and what your personal comfort level is. And of course, I know a lot more now 50 years later than I did when I was in my 20s. But ideally, if you were a 20-year-old, you'd set aside, and most people can do this if they're in a company where they have a 401k or something, you'd set aside a certain amount of money and you'd invest it mostly in equities, frankly, although a lot of people are encouraged, oh yeah, put a portion in bonds. Well, they're just slowing they're slowing it down. If you're in for the long term, you'd be better off just investing your entire 401k in equities and then forgetting about it. Rip Van Winkle would have been a great investor if he had invested in, the S&P 500 or whatever first, and then forgotten about it.
Sorry to interject, but a funny data point on that is apparently I've heard that people who work at big brokerages, they often say the best performing accounts are those for people who have died and the family hasn't come and claimed the assets, and they just or they don't make any changes, and so they tend to do the best over time.
That's right. Now, I'm not recommending death as a strategy, but you're right. That makes a lot of sense. The only problem with that is In fact, I would not recommend, if somebody has the guts, the wherewithal and personal confidence to do that and to just sit on it and not worry about it, I would not recommend that they take an income factory approach. But for those of us, and I'm one of them, who frankly, during the periods where it's down and you're kind of worrying, gee, I hope it's coming back. I hope this isn't the 1930s again and we're in for a 10-year or longer depression here and we need a war to get us out of it. For somebody who's unable or finds it uncomfortable to sit and just watch their equity investments go up and down, even though they know they're not going to need to touch the money for 10 years or 20 years or 30 years, the income factory, by allowing them to create their own growth, by investing in a pool of assets, you need wide diversification, but a pool of assets that's going to provide a steady 8%, 9%, 10%. Sometimes, like the last couple of years, we've gotten 11%, but I don't expect 11% year after year. But even if I get 8 or 9% consistently, I'm pretty happy then, regardless of what the price does in the interim, because I'm compounding and growing the income. And that 27-year-old, that's what they really, even if they don't fully realize it, that's what they really need 40 years later, their portfolio to be providing an income that they can easily live on, in retirement or whatever they're planning to do at that point. So either approach works, but it's nice to have the alternative, because if you didn't have an income factory alternative, then your alternative might be to start taking money out of the market at difficult times so you sleep better, putting it in the sidelines, investing in low return long-term bonds. And then all you're doing is decreasing your potential return, both in the short term and often in the long term, if you've tied yourself into long-term, low return assets.
Yeah, so we interview a lot of experienced investors who share your sentiment that we as humans can be our own worst enemies here at times in the stock market. And I've interviewed a number of behavioral economists who have the science, the behavioral science that goes into all of that. And what I really like about your approach is you just say, look, it's just math, right? You're just putting the power of math in your corner here, so that if you can not get too emotionally charged and tinker with it and screw things up, the math should see you through in the long run.
That's right. And it's especially comforting during those periods, and 2022 is the most recent, when stocks were universally down. And if you were only making a 1.5% dividend on your S&P 500 or whatever, but seeing the rest of it tank, to instead be earning your 9-10% and seeing it reinvested an even higher yield than it had been a year ago, I'll tell you, it really, you feel an awful lot more comfortable, and sanguine about your investment strategy than you would if all you saw was the downside.
All right, very understandable. So I think we've whetted people's interest enough here. So let's get to the meat of the discussion here. So tell us, what is an income factory and how do you construct one?
Well, an income factory, at a high level definition, an income factory would be a portfolio that you've invested in various assets that generate high current yields on a regular basis, but where you're not necessarily expecting growth. Ideally, if you bought something that was earning you 10% forever, a portfolio, let's say, that would generate 10 and didn't grow at all, you were able to compound it, or even if you were retired and you took 5 or 6% of it out, but you left 4% in to continue growing, because even if you're 70, you may live to 90 and you want to make sure you don't, outlive your money. That would be an equally good alternative. So you start at the high level by saying, okay, I'm committed to creating most of my growth through current yields. So that's at a high level. So then step two is you say, okay, what are the asset classes that I can consider? I think this is where you'd like to go now, right? What are the asset classes we should consider that would meet this requirement? And then what would be a portfolio that would contain those? And I'd say in general, they would be the kind of credit assets I already mentioned, like there are a lot of senior loan funds especially in the closed-end fund world. I like the closed-end fund world because if you're careful when you buy, you can often buy at discounts. So you end up buying a fund at a 8 or 10% discount to its net asset value. So you get a bunch of assets that are earning 8% or 9% yields, but because you've only paid 90% of their market price, because you got them at a discount, they're actually generating a higher yield for you. So you have senior loan funds, and they're run. You want to buy funds run by real professional organizations. There are senior loan funds run by Ares and Apollo and Blackstone and BlackRock and Invesco. Just give you an example. Blackstone is another one. I mean, these are companies I know because I spent years and years in banking, and when I was at Standard & Poor's, I developed the first ratings that were ever assigned to corporate loans. Corporate loans had never been rated before. So it's an area that's why got into this, because I'm familiar with these kinds of assets. So senior loans, and then the high yield bonds I mentioned. And again, you've got a lot of high yield bond funds. They're yielding in the 8-9%, some of them higher areas. And you want to, again, buy funds that are run by really solid organizations that know this well. PIMCO, of course, is well known for its fixed assets, although they're not so much into the corporate area as they are into the more standard bond areas. But you've got KKR, and again, Ares and Credit Suisse, BlackRock again, and some of the insurance companies like Barings, which is owned by Mass Mutual, is probably the best, has one of the best records out there. It's high yield bond funds. I'll give you a couple: MCI and MPV, if anybody wants to check out. But they've been at the top of the list for years in terms of their total return as high yield bond funds. And what makes some of these, why it's important to have really great management teams run by organizations that have been around a long time, is that a lot of these funds, they have great relationships with private equity firms. So even if they're lending in the middle market corporate area, they're lending to companies that are owned by other big firms that have a lot of skin in the game. So if you do run into credit problems, you've got an owner who's willing to work with you to try to prevent losses. So it really, there's a lot of sort of sophisticated people, organizations that are running these funds. And as retail investors, we can sort of tag on to their expertise and benefit from it. So high yield bond fund.
Sorry to interrupt just for 1 sec, Stephen. So so just to clarify for folks, so it sounds like you're saying, look, don't just pick an index fund, right? Pick a fund that is actively managed by one of these, professional managers. And a lot of the names that you've mentioned here, I'll say a lot of retail investors don't have a lot of love for these guys, because they kind of look at them as the guys that are dominating the system and slanting the playing field to their advantage and whatnot. But I think what you're saying is one, these guys are smart. They're winning the financial arms race, where they've amassed, a huge army of quantitative analysts and other sorts of advantages, and they have the relationships, so they can kind of, they can kind of play a little bit unfairly to their advantage, and you can use that advantage to your advantage as the small guy here by letting them be the guys who captain your actively managed fund here?
That's an interesting way to look at it.
You don't have to agree with it, but
No, I'm not. I don't think of them as playing unfairly, but you're absolutely right. People who do things for a living and are closer to it are more likely to have the connections and the knowledge. And I'm not talking about inside information or anything like that, but they know how the game is played, and they've been doing it for years. And some of the top rated funds are in fact run by these people. Like I mentioned MCI MPV because in what used to be called the private placement market, I don't know if maybe you're hearing a lot lately about the so-called private credit market, which a lot of the big names in finance and investing are talking about. It's like they've just discovered private credit in the last year or so and have been writing articles and everything about it. But private credit has been going on for generations. When I was a journalist for a brief period during my kind of midlife career switching, I used to write about the private placement market, and some of these insurance companies like the Prudential, Mass Mutual, they dominated the field in private placements, which were non-public debt. Like corporations would come to them and they would float a bond issue for them and sell it to other insurance companies. And this has turned into the so-called private credit market. And now you have lots of big investors involved in it. But these guys are pros. And I like letting pros run my money. I wouldn't dare go out and try to buy individual high yield bonds from individual high yield companies, but having Ares and Prudential and Mass Mutual and other people making decisions for me and having highly diversified portfolios like that I can buy at discounts in the closed-end fund market. Yeah, I really like that.
All right, great. So I'm sorry, I interrupted you. So we've gone through
No,
senior
I'm
loan
glad you did.
funds, high yield bond funds. What else would you
Yeah.
put in there?
Well, then you've got, there real estate. Now, real estate's really in the dumpster right now, but it seems to be turning around. Real estate has been for generations has been a good provider of steady, higher yielding returns. You don't get the growth, but you get
the cash flows.
Yeah, and so there are real estate funds that one can look at. Cohen and Steers is a big company that runs closed-end funds. They have a lot of real estate funds that have been around for ages that have done well. So I would say the real estate, there are lots of REITs around, but then there are funds that buy REITs. So, but real estate definitely would be something you might want to include. Some others, utilities and infrastructure is another asset class that while they're stocks, they tend to pay higher dividends. They're regulated, or now with infrastructure companies, sometimes they own regulated utilities, sometimes they own toll roads, they own all kinds of things that generate regular income. And if you buy these in the closed-end fund world, you've got some that have just been around for ages and pay nice, steady dividends in the 8% and larger. But some of the really solid ones, like there's one called Reeves Utility Income Fund. Its a symbol is UTG. It's been an investor favorite for years, and real solid. And it pays a yield of about 8.5%, and it's increased its dividend about 12 times in the last 20 years or so.
Okay, and is the theme pretty consistent amongst each of these asset classes, where you're saying, find ideally a closed-end fund that's professionally managed, if you're buying a closed-end fund, look to try to buy it at a discount. But again, more importantly,
right.
find a professional manager with a good track record in this
Oh, yeah.
space. Yeah.
Yeah, you want funds with really good track records that have been around a while. And then the other thing is, yeah, you're looking for investments that, yeah, they may grow over time, but you're mostly looking at a dividend that if that's all you got, you'd probably be pretty happy most years to just get that and reinvest it. And you're going to end up with a portfolio that maybe has an average return of 9 to 10% in terms of yield, but you'll have some superstars in it that are earning in the mid-teens, yielding in the mid-teens, and you'll have others that are, and we haven't gotten to those yet, but we will. And you have others that are, yielding in the 7, 8, 9%. And you mix them all together, well diversified, and you haven't, and you got your equity return in yield that you can compound as long as you want to get that equity growth.
And I'm probably jumping the gun here. Again, I don't want to interrupt your flow here, but it seems to me that sort of you can project with confidence. You can probably project with more confidence what you're going to end up with over a period of time, 10, 20, 30 years or so, because you're basically saying, all right, I'm putting my principal in, it's going to grow at X. I'm going to reinvest the X, right, every year, so I can calculate that compounding, and then I'm going to hopefully contribute, just from my own savings, a certain amount every year, so I can put that into the equation. And then you put all that into Excel, and you pretty much can say, all right, in 30 years, I should have this amount, and barring something crazy.
That's right. And the something crazies that you are not including. I mean, when you say barring it, you'll still think of them, but you can't always project. I mean, interest rate levels, which are driven by inflation rates as well, they're going to change over time. And if you think about what your return on a credit investment is, you've got a base rate that's a kind of interest-free rate, which was zero, over much of the last 15 years, but now is something more real, more like 3%, 4%, whatever, short-term government bill rates are. And then to that, you add your credit risk. So some of these same assets that are now earning us 10 or 11% in yield, were probably only yielding 6 and 7% 10 years ago because they were on a base rate that was much lower. So over time, if we really got inflation down to zero again, and I mean, it's quite likely that we might only earn 7 or 8% and reinvest and compound that at certain points in the future. But we'd probably be pretty happy with that because the economy would be, I mean, there'd be a lot of different things going on. When you have lower interest rates for longer, then you're discounting the future value of the cash flows at a lower discount rate. So they're actually going to then be valued more by a market. Now, I don't know anyone who expects interest rates to go down. The level of interest rates we're at right now is actually, while it seems high to many people, is about the average sort of rates we've had for the last 50 to 75 years for those who are old enough to kind of remember back. So I think most people I know don't expect rates to drop all that much, even when they finally start to go down. Now, to kind of continue on, there are some other asset classes that are very attractive. There's a specific one. Well, you have the business development company. I mentioned those earlier. BDCs, which many of your investors are probably already familiar with, are specialized companies that invest in, for the most part, middle market corporates. And that's all they do. And they are like little mini banks, except they're far less risky in many ways than banks. They're not nearly as leveraged. They can only leverage themselves about, I think, about 2 to 1 max. And instead of relying on deposits that can walk out the door in a bank run, they have long-term liabilities. So they have a liability side of their balance sheet that's far more fixed and under their control, and that they can match to their asset side better. So BDCs, they've had a terrific run over the past year or so, but I rely on them, and I like them a lot as an asset class. And there are some ETFs that are available. There's one called Putnam up in Boston, Putnam BDC, with the PBDC as the symbol, was just launched last year, and it's an actively managed ETF that invests in BDCs. So that's one I like. I like the idea of an actively managed ETF. And then there's another ETF run by it's called BIZD, the Van Eck BDC ETF, but it's BIZD, and it's got a very good record. But it's been around much longer. But it's interesting how PBDC, the actively managed BDC, beat BIZD, which is more of an index type of BDC fund, by about 3 percentage points over the past year. They both did very well. Like BIZD had a total return of 27% for the past year, but PBDC beat it with 30%. So last year was a very good year for credit investing generally, and for BDCs. But I really like BDCs because they're actively managed companies. They're kind of like mini banks, and I think they're going to be around, doing what they do, cranking out 9, 10, 11% yields, certainly in the closed-end fund sort of wrapper for a long time. And then there's also, I don't know if any of your readers, listeners, watchers, viewers are familiar with CLOs, collateralized loan obligations, but these are securitized vehicles that were only open to institutional investors for many, many years, where they would take senior corporate loans, secured corporate loans, and securitize them, put them into a pool. This started about 30 some years ago, when corporate loans were first becoming traded outside of the banking world. And CLOs, these collateralized loan obligations, are leveraged pools of senior loans. So the equity in them and the debt, they have different tranches of debt, have been very popular, as a number of retail funds have come out in the last 10 years to allow retail investors to invest in these. And they've been, they're not for the faint-hearted. I've written articles explaining what they are, but they've, as a small portion of one's portfolio, a couple of the funds are now generating yields that they're fully covering with their current cash flow of 16, 17, 18%. And then there are some other ones that buy CLO debt, which is less risky than CLO equity. And even some of them are earning and paying yields in the 14, 15% range. So CLOs are another asset class worth including in a small amount, in a diversified income factory. And then you've got covered call funds, which you may be familiar with, which are, they're equity funds. Eaton Vance is big and highly regarded in the covered call area, and has a whole bunch of closed-end funds that they run. But covered call funds are kind of an interesting investment to include as well, because they invest in stocks, some of the same stocks that growth stock funds invest in, but then they sell covered calls. So they're kind of selling off a portion of the potential income. If you knew the stocks were going to go up and you were positive of that, you'd never sell a covered call on it. But if you don't know that for sure, it's a nice way to convert to increase the regular income on the fund, so that you're trading off potential potential growth for a steady income. So covered call funds, and many of these generate nice steady yields of 7-8%, and they've been doing it for years. They're a nice component of an income factory as well. So we've got senior loans,
right.
real estate, high yield bonds, and then there are plain old equity funds that, especially in the closed-end fund world, there are a lot of equity funds that are kind of growth type funds, but they pay out their growth as they earn it, as they make capital gains, they actually pay it out. So they have much higher yields than a typical sort of index fund would have. There are quite a few of those in the that are in the closed-end fund world. Some of you want some names? We
Yeah,
that
give
have
some
been
names to
around
some
a
of those
long
if you can.
time. Yeah, like the Adams Diversified Equity Fund, ADX, has been around for years, generating, solid returns. And you've got Liberty All-Star Growth, which is another oldie but goodie in the closed-end fund world, in a lot of pretty conservative portfolios, I would guess. It's ASG. And then you've got Charlie Royce. People may know he's probably in his 80s now, but the Royce Value Trust, the Royce Microcap Trust, they've been around for years, earning really solid, returns. They're growth funds, more likely to be mid cap, and but they pay out nice dividend. They convert their growth, their capital gains, into a steady income. They know that closed-end fund investors are typically more interested in getting their money out regularly as dividends than in seeing it just. They'd rather do the growing themselves by compounding than with a typical growth stock. The stock just does the growth internally and pays you 1% or whatever.
All right. So sorry to be repetitive here, but pretty much in every asset class you've mentioned so far, the strategy is the same. You typically buy closed-end funds, ideally try to buy them at a discount if you can, but look for a good senior manager with a long track record. So even here on the equity funds, same deal, closed-end funds.
Absolutely. That's right. This is why, funds, I don't claim to be a great stock picker. I'm good at theory, and I think of myself as a portfolio manager more than an individual stock analyst. That's why I spend my time finding funds run by people who know a lot more than I do and have been doing it a long time. And it works so far.
Great. I mean, what I kind of take from your approach here is you're leveraging the sort of safety of the contract with these instruments. You're leveraging math, having a strong sense of what you're going to get back and how it's going to compound, and you're leveraging expertise and competitive advantage by going after or letting the active management be done by the really big successful guys.
That's right. Which is why, for people willing to, do enough research, which might mean, and I'm not just trying to promote my own stuff, but I mean, I've spent a lot of years writing about this, doing articles on Seeking Alpha about it. And so most of the people that are followers of mine or members of my investment service are smart retail investors, but who do it themselves. But what they're doing is you don't need the level of expertise to pick funds that you do to pick individual stocks or bonds. And so that's what I try to do, is I try to keep it as simple as I can. And that's why we stick to funds, and funds run by pros.
Okay. Before I get to my next questions, were there any other major asset classes here you'd want to mention?
No, I think we got the basic ones. No, that would be about right. I mean, we covered stocks, bonds, major corporate debt instruments, and some special things like BDCs and CLOs.
All right. Well, I really appreciate you mentioning, certain fund companies that folks can look into. You even gave some tickers along the way. Just want to underscore for folks, both for Stephen's sake and mine, none of this is personal financial advice. These
God,
are just things to go consider. I'm going to
right.
make my pitch in a little bit, my standard pitch for why most people, unless you're experienced DIY, should work under the guidance of a good professional financial advisor and/or follow somebody like Stephen, who has a service that shows you all the analysis and lets you actually do the work on your own. But yes, none of this is personal financial advice.
No, and I would add, anything I write and any of my service, I make a point of saying what I'm doing is sharing my own opinions of what I do and how I invest and what works for me so far. But there's no assurance it's going to keep working for me, or guarantees that, we're all in this together, kind of helping each other, but none of us are professionals, and certainly there are no guarantees.
Okay. Well, look, can you talk for a bit about the just differentiate for our viewers the accumulation phase of the income factory, right? Which is that, hey, like I'm in my early 50s, right? I'm going to be building the factory. I'm going to be putting money into it, hopefully for a good while, not taking money out. So contrast that versus the withdraw phase. How does the factory work when people start taking, a partial or total annual returns out?
Okay, that's a good question, and I get it a lot. When you think about total return on any investment, your total return is the amount of cash you collect, say in any period, say in a year. It's the amount of cash you collect from that investment and the amount by which that investment goes up or down. Now, at any age, you have a choice at the end of any year what to do with that total return. Now, if the total return is mostly in the form of capital growth, then you always have the option of selling some of your assets, taking some of the growth and harvesting it and collecting it for whatever you need it for, to build a house, buy a car, whatever, send your kids to college. Now, once you get into a retirement phase, that really doesn't change. It's just that most retirees have more of a need, when you're in your accumulative phase from age 25 to 55 or 60 or 65, you've still got the choice each year. Do I need to take money out for some reason or another? But you're right, going to leave it in. If you want it to grow, you'll mostly leave it in. And if it's in an IRA or something, you'll definitely want to leave it in. Once you're retired, people who have traditional investment strategies almost have to start selling assets, because they're only going to get 1.5 or 2% in dividend payments. So they have to start selling off some of their growth. Hopefully not all of it, though. If you've got an income factory and you're getting it all in the form of income, then your choice becomes, how much do I want to keep of that income and how much do I want to reinvest it? So if you've got a traditional portfolio and you're earning on average 10% a year, some years you won't earn any of that, you have no choice but to sell off some of your assets each year if you need it to live on, with whether you've earned, a capital gain or not. With an income factory, if you're earning 10% or whatever in yield, it's your choice. They generally say you shouldn't take out more than 5-6% or so, 7%, and you ought to keep the rest in and let it grow. I mean, that's going to depend on your outlook, how much, other income you have, all that stuff. But I'd say the average person 65 or 70 should still be thinking of themselves as in an accumulative phase, even if they're taking out 5% or so, because you might live to 90. I mean, my grandparents and my father lived to 96. I'm in my 70s, but I'm still thinking growth, because I want to have, I want to at least prepare for being around 20 more years, even if I'm not lucky enough to make it. So, I mean, so seriously, this is a question that doesn't really change that much just because you go from being 50 to 60 to 70. It's more, but if you do have an income factory where it's all coming in cash, it's a much easier decision about, because you're used to reinvesting it anyway. Now it's just a question of, well, maybe each year I'll cut back the amount I reinvest by a little bit and keep it. And how much you keep will depend on what your current needs are, as a retiree, if you're living solely on that. You know what I mean? So it's very much it's a lot easier with an income factory to make the decision, because you always have cash that's coming in. You don't have to sell stocks that might be down.
Right. It seems to me, rather than kind of building a nest egg that you're going to then draw down in your twilight years, you're building a pension plan.
That's right.
Yeah, that is paying you an annual salary, and then you can just determine how much of that you want to take and how much of it you want to reinvest. But even if you take all of it, you're not actually dipping into your principal there.
That's the critical point, and that's why it's so important to look at the source of a fund's yield. If it's paying you a yield every year, and it's paying it from interest, what they call net investment income in the fund world. If you're collecting net investment income, which means the interest or dividends the fund receives, and it's not dipping into its own capital gains in order to pay you that yield, then you can be a lot more comfortable spending more of that yield and not reinvesting it than if it were from a stock fund where they're selling you, they're eating their seed corn, so to speak, to pay you a dividend because they didn't have the capital gains that year to cover it. I've written a lot about that, and that's a real issue. As people get closer to retirement, it makes more sense to have an income factory approach, because you're more likely to have a portfolio that generates cash flow each year, even if its paper value is going up or down, because you won't have to sell any of those assets and sell it at those lower paper values.
And let's talk about the paper values for a second. So you've done a good job of laying out the benefits of the income factory. I'd love to hear your thoughts on any risks that folks would need to keep in mind. And one that comes into my mind, and maybe it's a real risk, maybe it's not, you can correct me, is let's say I was assembling an income factory myself, or I was picking the individual bonds to go in it, the individual assets to go in it. I would have the guarantee that if I held them to maturity, no matter what happened along the way with prices, I'd get my principal back, right? Some of these ETFs don't, I presume they don't necessarily give you that guarantee. If you were to sell the ETF, you're just selling it whatever the market price of the ETF is at that given moment, right? So what kind of risk is there that, yes, it's churning off the income you want over time, but you might have a life event or whatever where you need to start selling the principal, and it's substantially lower than you'd like it to be 30 years down the road, versus that guaranteed principal return. How big of a factor is that in your outlook here?
That's always going to be a factor, whether you've got a stock portfolio or a fixed income factory type portfolio. The market can always react negatively, as it has in the last few years. There have been years where, I mean, in my own personal portfolio, it's actually right at a break-even point right now, which I'm delighted at, because I've been collecting 10 and 11% yields for years on it. But there was a time when it was way down a couple of years ago in paper value, but it was continuing to crank out the income. And I'd say if somebody thinks they're likely to have a life event, and some aren't, you can't project everything, but if you know your kids are going to college in so many years, or you're saving up to buy a house or something, those kinds of things, you should probably set aside a portion of your savings for and invest it in something that's not as volatile. I mean, that for those, well, shorter term treasuries and shorter term bonds that currently you can get 5% or so on. I mean, that's not what I'm looking for my whole portfolio. But if I were saving a certain amount of money for equity on a home or send my kids to college, and I knew it was going to be in a few years, I would be more likely to set aside, to do something like that. But the major risk, I would say, for the long-term investor is you always have the risk that today's dividend or that you'll have some losses, or that yield rates will drop, and that your fund that's now paying you 9% might drop and only pay you 8.5%. I mean, this is real. This is why I set my goals. Even though I've been earning 10 and 11% for the last couple of years, I keep telling myself and readers that, look, this is special. We've had, because you've had so much volatility in the market, there have been fears of a recession that hasn't come yet. Maybe it will or not. There have been discounts on loans and bonds that a smart fund manager can buy bonds and loans at discounts, when they're and then they mature. If they don't go bust, and 98% of them don't, you buy something at 92 cents on the dollar, and then they resell it, or not resell it, it matures in a few years and the company pays off at par. You've got a nice capital gain there. So there's been a lot of that boosting returns lately, as loans and bonds have been selling at bigger discounts than usual because of all the angst in the market. Now, so you have things that can influence the size of your cash flow over time. And so, you can't fall in love with 10%. And you have to realize that, hey, I might be compounding at 8%, in 5 years or 10 years, but as long as you're compounding, it's still going to grow, but the fact that nothing is assured, and that rates from yields from funds aren't guaranteed, that can vary, and it hasn't affected the overall effectiveness of the strategy so far.
All right, and we got to start wrapping up here, unfortunately, but it's been a fascinating discussion. I'm curious, interest rates getting hiked to where they are right now, back when we were sort of in a ZIRP world, I'm just curious, what type of returns was your income factory portfolio returning?
Well, I get more and more, this became more and more my way of investing. I mean, I transitioned from a more traditional form of investing, but I'd say.
But your book came out in early 2020, so right before everything went crazy.
That's right. I'd say back then I was talking more about 8 to 9% as my more realistic target level of yields, what I would have been happy to kind of, for a lifetime of yields at 8 or 9%, and just compounding them. This getting 10, 11, 12% over the last couple of years it's been great, but I keep trying to tell myself and my readers that, we can't count on this forever. But on the other hand, I don't expect it to go back to a zero, rate program.
Rate environment. Yeah. So all I want to say is, 8%.
Yeah. The long-term mortgage rate, the 30-year mortgage rate average for the last 50 years was something like 7% or so, just to kind of keep that in mind.
Keep it in perspective. Yeah. So, I just wanted to point out that 8% in a ZIRP world, on the fixed income side, credit side, not so bad. I know a lot of people that'd be interested in that. And I just remember in 2022, when everybody's portfolio was doing poorly because stocks and bonds were going down. I can't tell you how many people, Stephen, came to me and said, God, if I could just find a way to get 4% consistently going forward from here, I'll be happy. I don't need anything more than that, right? Just something that I can sleep at night in and get a consistent 4%. And you're offering something that, I
Oh,
mean, no guarantees, but has been performing at twice or better than that with the
and
ability to sleep.
that's right. And even a most conservative investor, if I were to sit down and get rid of some of the things I own that are more aggressive, you could probably pretty much count on a 7 or 8% return, yield, indefinitely.
Okay. All right. Well, look, thank you for doing this. You've done a really great job in helping beginning to demystify the world of income generating assets for our viewers here. You've definitely given something them to chew on. Like I said, the structure of what you're offering here, I think to many people, it sounds pretty compelling. Now, obviously, everybody got to do your own research. An important part of that research could be reading your book. So, Stephen, if folks want to read your book, where can they get it?
Oh, well, they can get it. If I were one of these people that's interviewed all the time on CNBC, I'd have a whole bunch of these on a bookshelf behind me all through the show. But no, on Amazon, The Income Factory, there it is. And
So
and
go to Amazon or wherever they sell books. Before we
yeah,
turned on the camera, we were sort of talking about how solutions like yours don't get a lot of airtime on the traditional financial media because they're not sexy, right? What sells is the the boom of the day, which stock just
right.
went up 30% yesterday because of some news, right? And also a lot of these media companies, their advertisers
Mm-hmm.
are big ETFs, and they tend to be on the equity side. And fixed income is sometimes like watching paint dry. But
Mm-hmm.
if your horse finishes the race and that's all you need to do to win, that's, as an investor, that's great. But as a network trying to get people to tune in tomorrow for the next big soundbite, it's not super effective for that, right?
Oh, absolutely right. And in fact, in my book, I spend the introduction, and my favorite chapter, chapter 2, is why do we invest? What makes us wealthy? And I talk about this transition that's taken place back when people had pension plans and they didn't have to run their own money. They weren't watching TV nearly as much. But with a media that requires people to worry about growth and indexes and the sort of things that they focus on, yeah, you're not going to hear much about letting the paint dry with boring income factory strategies. But I appreciate your interest in it.
No, well, thanks. Well, it's just reflecting our audience's interest in it. So, for folks that have really enjoyed this conversation, whether they get your book or not, where else can they go to follow you and your work?
Well, if they follow Seeking Alpha, I've been writing on Seeking Alpha for 20 years. That's a worldwide website focused on investing. It's got millions of readers and actually thousands of writers, contributors, and I became one 20 years ago or so. And then a few years ago, they invited some of the more popular writers, I guess, to set up separate investment subscription services that they host on Seeking Alpha. So by then I'd written my Income Factory book, so I created a service inside the Income Factory. So people can read public articles of mine on Seeking Alpha, or they can take the next step and investigate my Inside the Income Factory service. There's a free trial available and all that.
All right, it's great. So if they go to Seeking Alpha and they type in your name,
Oh, they'll
Stephen
find
Bavaria, they'll find you.
if
Okay.
they Google Stephen Bavaria, they'll find all this stuff. Yeah.
Okay, great. And Stephen, we'll put links to your book and your free and your premium Substack, Seeking Alpha page
Right.
in the description below this video. So folks, if you want to get just direct one-click access to that, you'll find it there.
Thank you.
All right. So Stephen, I've got one last question for you. And I'll give you about a minute to chew on it because I got to do some housekeeping first. And folks, you're going to want to hear the housekeeping because there's some interesting resources for you there. But the question is going to be, we've been talking all about money and financial returns in this discussion, but what's one non-money related investment that you would encourage folks to consider adopting in their lives? Real quick before we get to that, folks, if you've enjoyed having Stephen on here, time got short. There's still a lot I'd love to talk to them about. If you'd like to have them back on the program again in the future to elaborate on income investing, please let them know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Just a reminder that the Thoughtful Money Spring Conference is coming up very fast now, and that lowest early bird price discount is still being offered, but that's going to go away at the end of the month, which is coming up quickly. So don't delay anymore. If you're interested in registering for the conference, do it now to lock in that lowest price. And if you're a premium subscriber to our Substack, you get $50 off that lowest early bird price. Another benefit that premium subscribers of the Substack are going to get is I wrote a piece a couple of years ago, basically just sort of, it's a primer on income investing. And it just basically talks about all the major common assets, many of which Stephen talked about here, but there are others that we didn't have a chance to get into. So that primer just basically sort of explains what they all are. I know we used a lot of terminology in this discussion that maybe not everybody knows. That primer does a good job of sort of explaining what each of those things are. I'll be sending that after this interview to all my premium subscribers on Substack. So if you're interested in getting that as well, and you're not yet a premium subscriber, consider upgrading. It's only $15 a month, folks, and you'll get that $50 discount to the conference I just mentioned, plus that free primer or that primer on income investing, and of course all the other benefits that you get for signing up for Substack, like my notes to all these interviews and all the other benefits that the subscribers get. All right. Last, I just want to underscore again, none of what was said in here was personal financial advice, but I think for a lot of people, dealing with credit and fixed income instruments, it's a little bit more challenging initially, just because it's a little bit more mathy for people, and a lot of people get scared by that. And a lot of people just don't have experience investing in these instruments. And so, as I do every week, I highly recommend that unless you're an experienced DIY person yourself, that you work under the guidance of a good financial advisor, professional financial advisor, who takes into account and understands and appreciates everything that Stephen and I talked about here. If you've got a good one who can do that for you, great, stick with them. But if you don't, or you'd like to get input from one who does, consider talking to one of the financial advisors that Thoughtful Money endorses. These consultations that you can have with them, they're totally free. To sign up for one, just go to thoughtfulmoney.com, fill out the short form there. But like I said, they don't cost you anything. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible, position as prudently as possible in building their wealth going forward. All right, thanks for hanging in there, Stephen. We're now here at that last question. What's one non-money related investment you'd encourage folks to consider?
Well, it may sound fairly perfunctory to a lot of people, but I'd say, just to build up to the answer a little bit, I find I know so much more now, and I'm in my mid-70s. I know so much more now than I ever did years ago, and I wish, that I'd known it sooner, but I didn't. And so now one of my goals, whether it's from an investing point of view or just living, is to try to live as long as I can and be healthy while I'm doing it, so I can apply all these lessons that I've been learning for the last 70 years, some of them really the hard way. And I said, I come from good Italian stock, I guess, where my grandfather Giuseppe came over on a wooden ship in 1901 as a teenager and worked in the slate quarries and managed to live to be 96. My dad went through the Second World War, was at Iwo Jima, was married 50 odd years, some of them not so odd, and lived to 96 too. So I'm hoping I've got the genes, and I'm hoping I can do it and continue to make some kind of a useful contribution and enjoy myself, for the next 20 years. So it all depends on, just staying healthy and keeping your mind wide open to new ideas and everything. So I would say that's the most important thing. And if you're younger than I am, and most of you probably are, start working on it now. We live in a 55 and over community, and I see a lot of my neighbors and others, some of whom are younger than me. And I don't want to pass judgment, but I think some of them wish they had started earlier, taking care of themselves. And so that's the most important thing you can do. Take care of yourselves physically, mentally, spiritually, however you can, and it'll help your investing and your living, I think.
Great point. Folks know that I talk about this topic a lot here, but invest in your functional health, both physically, mentally, spiritually, as you said, so that just like the horses in your analogy, you actually finish the race, right? What good is building up this whole income engine if you clock out halfway through the race because you didn't take good enough care of yourself?
Great.
All right. Well, look, it's been a wonderful conversation. Thanks so much for coming on, explaining all these instruments for us, demystifying it for us, but also presenting your framework that I think a lot of people are going to find really interesting. And I love bringing on practical, actionable ideas like this. And you've done that in spades here, Stephen. I really look forward to having you back on the program again at some point in the future. But thanks so much for giving us so much time, and everybody else, thanks so much for watching.
My pleasure. Thank you.